Hello everyone, my name is Givemo Maguju, and in this tutorial I'm going to teach you accounting, and you will learn financial statement flows. And this means that you will learn how items in the income statement affect the cash flow statement and affect the balance sheet. So without wasting time, let's dive right into it. So we are going to make use of this guide that I've prepared of a fictitious company, and this company is in the business of selling tables, and they sell one table for $100, and they purchase the raw materials to manufacture the tables at $50, right? So the idea here of this exercise tutorial example is for you to grasp the accounting concepts and understand how each transaction flows through the income statement, cash flow statement, and balance sheet, right? So we are going to focus on one transaction at a time to make sure that we completely see how each and every transaction is affecting the income statement, the cash flow statement, and the balance sheet, right? And at each and every scenario, from 1 to 7, we will make sure that our balance sheet balances. Okay, so let's begin with scenario 1. So scenario 1 here, it's saying we bought raw materials to build 10 tables at $50 each. So record this transaction in the cash flow statement and balance sheet, right? So if you have knowledge of accounting or some previous accounting background, you will know at once that this is a cash purchase. So we need to see the effect of that in the cash flow statement and the balance sheet. But before we do that, you need to understand that when we buy inventory, right, in this case raw material is inventory, right? When you buy inventory, the cash flow statement will since it's an increase in inventory, we'll record it as cash outflow in the cash flow statement. And in the balance sheet, we are going to create an inventory asset account, right, where we are going to record the 500 where we are going to record the inventory that is worth $500. So let's just do that right away. So let's go to Excel, and here we are going to highlight. So to highlight this, I want to just format this Excel sheet. So before that, let's just rename that to financial statement flows. Okay, and let's just highlight. To highlight, press on your keyboard Control A, and then press Control 1 to access the formatting panel, right? So let's select Arial Narrow, and then let's write here scenario 1, and then let's bold. So to bold is Control B, right? So let's write cash flow, and then let's write here amount, and let's write here balance sheet, and let's write here amount, right? So hold down shift on a keyboard and press your right arrow up until column I, and then press Control B to bold. Right, so let's go to this column D, and then press Control space on your keyboard to highlight the entire column. And then on your keyboard, we want to make sure that we center our numbers there. So Alt HAC, and then we want to add decimal places. So whilst column D is still highlighted, on your keyboard hold down shift, hold down Control Shift, then 1. Let's do the same here. Control space, and then hold down Control Shift 1, and then let's center Alt HAC, just like that. Right, so we are ready to go. But before we work on the cash flow statement, I want to explain something, that our the income statement, the last figure, the net income figure, it drives the cash flow statement. So normally when you are working or when you are preparing a cash flow statement, you have to start with the figure from the income statement, which is the net income. So the purpose, right, the purpose is to see how much cash the business is generated from net income or net profit. Okay, that's the reason why we always start with net income, to find out how much cash the business is generated from net income or net profit, right? So in this way we will add back non-cash items, and we will subtract revenue received or revenue recorded on credit or revenue received on credit, right? So revenue received on credit is accounts receivable, right? So basically that's it. So let's start with net income or profit, and then here we record amount 0 because we haven't generated any income yet. And then here, since we have purchased inventory, we have to show the effect of that in the cash flow statement. So when we purchase inventory, obviously it's cash outflow. So we are going to, in other words, we have used money. So we have to show that in the cash flow statement that indeed we have used money. So changes in inventory, and then we have to show that with a negative figure of 500, and then nothing else. Then we are going to say total changes in cash, right? So right, so the figure here, total changes in cash, it affects our cash balance in the balance sheet, whereas the net income from the income statement starts or drive the cash flow statement. The net income figure as well, it affects our retained earnings figure in the balance sheet, right? So here we are going to do a quick auto sum. So Alt plus, then that's it. Then here we have to say cash. We have to create an inventory asset here, since we've bought some inventory. Perfect. And then here we have got a negative balance of cash from the cash flow statement. We take it from here, total changes in cash, which is this balance. Okay, then retained earnings, since we haven't generated any income yet, it will remain 0 because here the income figure here it's 0. So that's cool. So for now we can underline that because we are done with that transaction. So to underline, we are going to press Alt HBP, and then we have underlined that. Then we are going to scenario 2, right? So let's go back to our Word document. So we are done with scenario 1. Our balance sheet is balancing, as you can see here. We have got current assets, negative cash balance plus inventory, right? So in scenario 2, it's saying the cash balance in scenario 1 is negative, and that means we can't pay for these raw materials, since this was a cash sale. But now, as you can see from the previous example, that the cash balance is negative, so we can't pay. But here the vendor has agreed that we can defer the payment of these raw materials now until we are able to come up with the cash, right, later. So record this transaction in the cash flow statement and balance sheet, right? So let's work on this now. So here, this is okay, so let's just do that. Okay, so let's just copy that, and let's Control V, escape, right? So mind you that this was a cash purchase, right, this was a cash purchase and this is a credit purchase. So basically we are done with the cash purchase on top there. Now scenario 2 is entirely a new one, right? So here we will start with net income, and we're going to record changes in inventory. We're going to record changes in accounts payables, right? Because right now when you are not when you buy inventory on credit, you will have a liability. You have to create a liability in your books because you are supposed to pay that liability later on when you have generated some funds. So changes in accounts payables, right? So here changes in inventory, it's showing that we have bought inventory, right? But it's also showing that the supplier is also agreed that we can pay back later. So here we are seeing that there's an increase in accounts payable, and this increase we treat it as cash inflow. In other words, we are saying this is an expense. It's a non-cash expense because we haven't paid cash for this inventory, therefore we have to add it back. That's why we are putting it as a positive. We have to add it back because it's a non-cash expense, right? Then here we have to say total changes in cash. Right here we have to bold just like that, and here the value, the figure is 0. Then we have to just do a quick auto sum, so our balance comes to 0. Then our cash balance, obviously we haven't used any cash, so our cash balance is 0. Then we create an inventory of asset there of 500, and then accounts payables of 500, and then retained earnings of 0. Okay, so here the reason why we've got cash 0 balance here is because you've got total changes in cash is 0, then you've got 0 balance. Okay, then inventory, obviously we are recording this effect there. We have bought inventory, we have recorded inventory under current asset. Then changes in account payables, here we have recorded that. Then obviously our net income is 0, so obviously this figure should be 0 as well. So our balance sheet balances, because we've got current assets worth 500 and equity plus liabilities worth 500. So that's perfect. So let's just underline that because we are done with this section. So to underline, we said Alt HBP. That's it. Let's go back to another scenario 3. So here scenario 3 is saying we sold one table for 100. This transaction resulted in revenue of 100 being recorded and COGS incurred of 50. Assuming that income tax is 40%, record revenue in income statement, cash flow statement, and balance sheet. So this is cash sale, right? We sold this for cash, so we have to record that in the income statement, cash flow statement, and balance sheet, right? So let's just do that. So this is scenario 3. So scenario 3, and then we say cash sale, right? So first of all, we are going to create an income statement here, right? So when we have a sale, there are two things, right? We have a sale, that's revenue. We also incur cost of sales. Okay, so we are going also to record that, but for now we are dealing with revenue, right? So this is revenue here, and let's just put the amount there, right? So we say revenue, and then we highlight that. Right. So here we put taxes, because we are assuming that our taxes are 40% as per our scenario guide here. Right. So now we have got net income. Right. So this is a short income statement to see the effect of revenue. Okay. So we just want to see like how much cash did the business generate from our revenue, okay, or from the income statement, just like that. But we are going to record everything, right? So here we have got 100 is our revenue figure, and obviously we have to say equals to we have to calculate the tax, so times 0.4, right? And then obviously to get the net income, we're going to say 100 minus 4 minus this one, so it's 60. So our net income is 60. So I think you may, in fact, at this point you can get confused, like what is this 44? Okay, so this 40, these are taxes due on this cell, okay, and tax professionals, they call it input tax, right? Because you know, when you sell something, right, if you're a business, obviously your business may have might be registered for VAT, so obviously you charge your tables, they are charging their tables plus VAT. So this is the input tax, okay, which is fantastic, which the customer pays, right? So which is also due on these sales, right? So now we have to record that, we have to record that in the cash flow and the balance sheet. So let's just see how to do that. So just that, then here we are going to say net income. In this example, we've got 60 under net income, right? So we were told that there was a cash sale, and we sold and we sold one table. So this is for only one table, so nothing else. So we are saying total changes, so total changes in cash, obviously with this one we've got 60, and then on the balance sheet now we have to make some adjustments here. So we are going to copy this, right, and we are going to paste it down here, okay, like that. So here, like I said before, that net income, this net income from income statement drives the cash flow statement, and here we've taken this figure, we've started our cash flow with the net income of 60, and our total changes in cash is also 60, okay, because there is no other transaction that we can record, it's just a cash sum, okay. So this net income now in the cash flow statement also affects our retained earnings, so which means our retained earnings will be 0 plus 60, okay, which means, right, so our retained earnings will be 60, right? And here the total changes in cash will affect our cash balance, which means here we are going to say equals 0 plus 60 as well, so such that our balance sheet will balance with cash, inventory 560, and accounts payables and retained earnings, which is fantastic. There is also, yes, there's also here record COGS in the income statement, right? So we want to record COGS, right, which are cost of goods sold, right? So we are going to copy this short income statement there, and we are going to paste it just like that, and then we will come here and change this to COGS. So our COGS, since we sold one table, so the COGS for one table, the cost is 50. So it's not just 50, but it's minus 50, because COGS, we treat them as direct expenses. Okay, so which is fantastic. Now we need to copy this, right? So we copy this and then we paste here, right? So we need to record the effect of this. So the net income here, so we'll start with net income. So our net income is negative 30, right? But basically, you may also be wondering here, these are taxes due on purchase, right? Which we call this output tax. So there's input and output tax, right? So this is fantastic, and let's just copy our mini balance sheet there, right? So we copy our main balance sheet and then we paste it there, and we come here, we say total. So here, since we have sold inventory, so when we make a sale, we have to reduce our inventory with the amount that we bought the inventory for, right? So since we just sold one item, it means we are going to reduce our inventory with the cost of inventory of one item. So here we are going to say changes. We're going to say changes in inventory. This time around, since we have sold inventory, so this is cash inflow, so we just put 50 there because we are getting cash. So we are going to say total changes in cash, total changes in cash here. So we just do a quick auto sum, which is 20 there, right? And here, so what we are going to do here, we are going to say, since our total changes in cash is 20, here our cash balance will change. We are going to say equals 60 plus 20, right? And our cash balance becomes 80 there. And then here we are going to reduce our retained earnings figure with that negative net income figure there. So we're going to say equals 60 minus 30. So we are left with 30, and we are going to reduce our inventory with 50, with the 50 there. So we're going to say equals 500 minus 50. Okay, such that if we add this, it's 530, again it's 530. So our balance sheet balances. Okay, so let's just do that quickly, check that. So we're going to say 450 plus 80, so it's 530. So it means our balance sheet balances. Okay, so let's just underline so that, right, so alt HBP, right? So this is fantastic. Then let's go back to our scenario. Now we are going to scenario 4 because we are done with scenario 3, so we go to scenario 4. So let's go to scenario 4 here. So we are going to say scenario 4, right? So scenario 4, what is it saying? Scenario 4 says sold one table on credit for 100, and obviously we incurred COGS of 50, assuming that income tax is 40%. Record this transaction in the, so we're going to record the revenue on credit, and we're going to do that as well for COGS. So remind you that the above, this was a cash sale. Okay, so we are going to record for a credit. This is a credit sale. Okay, so this is a credit sale now. Okay, so what we are going to do is we are going to copy this mini income statement here, right? Then we just paste it here and we press escape, and let's just copy this as well, right? And then let's paste it here, and that's it, right? So this won't change, okay, because this is we sold, but this is on credit, which is fine. So let's just copy this. Let's paste it here, right? And then here we are going to say net income. So our net income obviously will be 60 because that's there. And since this is a cash sale, it means although we have recorded the revenue in the income statement is 100, but we haven't received the money yet. Okay, so which means we will create an accounts receivables in the balance sheet. Okay, so an accounts receivable is a representation of the revenue we haven't yet received, but we are going to subtract that in the cash flow statement because we want to see the effect of that. So here we are going to say changes in accounts receivables, right? Changes in accounts receivables, which is how much? Which is 100. Okay, because our accounts receivables are increasing, we haven't received the money yet. So here we are going to say total changes in cash. Okay, so here we're going to do a quick auto sum there, right? So, and it gives us 40 there. And here we will just change things a bit. So we are going to say accounts receivables. So accounts receivables will be 100, and then accounts payables, they will remain on 500. Then retained earnings will remain at 30. Okay, perfect. So we want to change our figures based on these ones. So our net income here, the retained earnings figure will add 60 to this. So we're going to say equals 30 plus 60 to get 90. Okay, then here we are going to subtract 40 there. So we're going to say 80 minus 40 because our cash balance is negative, but the accounts receivables is 100. Okay, then inventory obviously it's 450. Perfect. So if we try here, you'll see that it's 590. So our balance sheet balances. So let's just underline that, Alt HBP. Right, so we want to record COGS, right? So what we are going to do is we are going to copy this mini income statement for COGS, right? So we are going to paste it here just like that, and we are going to copy this, right? And we are going to paste it there, and here we are going to copy everything here and paste them under the balance sheet, right? Perfect. So we are ready to work now. Right. So this is a credit sum. So we are going to say income statement, and then our is 30, because here we have incurred cogs of 50, right? Then here we are saying, here we want to record the effect of, see, whether it's a credit cell or a cash cell, we still need to record the effect of inventory. Even if it is a credit cell, we still have to reduce our inventory, because we treat it as if we've sold the inventory. Okay, so we are going to say changes in inventory. Okay, so since it's a credit, so we've sold inventory, so we have to reduce that, right? So total changes in cash, right? So total changes in cash, then auto sum, quick one, which is 20 there. Then let's just make adjustments, right? So the income statement here is going to decrease by 30, which is this figure. So we are going to say equals 90 minus 30, which is 60 there. Then here our cash is going to increase by 20, which is 60. Okay, perfect. Then here our inventory is going to decrease by 50, right? So we are left with 400. So here if we say 4 plus 100, 560, 560, 560, so our balance sheet balances. And then we have to out HBP underline there, right? So we are almost done. Let's just finish up. Then we are going to scenario 5. So scenario 5 is saying sold remaining 8 tables, 4 of which have been sold on credit at 100 each. Cogs, these are the cogs, right? So record this transaction, okay, assuming that tax is 40%. Okay, so here we are going to write scenario 5, and obviously it's a credit cell. It's a credit and cash cell. Okay, perfect. Right, so here we are going to copy the income statement there, right? So we copy it and then we paste it here, then we press escape, right? So our revenue here it's saying that sold remaining 8 tables, 4 of which have been sold on credit, right? Which means if we sold 8, we are also going to multiply our COGS price with 8, okay, to get the cost of sales, right? So here we are going to put 800, because 8 times 100, okay. Then here we are going to copy this, then we have to copy this, we have to paste, something like that. Then once we do that, we have to copy all these things there, and then we paste them here, right? So now that we've done this, then here we have to start with our net income. So saying net income is equals to 480 there, and since this is a credit cell, it's the statement here is saying sold remaining 8 tables, 4 of which have been sold on credit. Okay, so we are only going to adjust, we are only going to subtract the revenue that was received on credit. So to do that, we are going to say changes in accounts receivables, which means our accounts receivables have increased by 400. So we are going to subtract that in the cash flow statement. Then we are going to say total changes in cash, right? So which means if we run an auto sum here, then we are left only with 80. Okay, so our total cash is going to be affected by 80. So we're going to say goes to 60 plus 80, then we get 140, right? And then our accounts receivable is going to increase by 400, then this becomes 500, right? And then our net income is going to increase by 480. So it means we're going to say 60 plus 480, then we get 540 there. Right, such that if we say it becomes 540 plus 500, then it becomes 1040. So 1040, and then our balance sheet is balancing. So we are going to say Alt HBP. Okay, and let's finish the rest. So we're gonna finish the other one, the COGS one, right? Because it's saying 4 of which, so we're going to adjust only for 4, right? But the cost of sales will include the ones for cash. So it's 8 times 50, then later on we adjust for 4. Right, perfect. Then what we are going to do is we are going to copy this mini income statement there, and then we paste it there, right? And once we paste this, we are going to say 8 times 50, obviously we get 400. Okay, because we're going to say if we say, because 8 times 50 we get 400, right? So that's perfect. Then we have to copy this and we have to paste that, right? Then once we do that, we have to go back again and copy everything here, and then here we have to paste that, right? So once we do that, then we have to start here with net income, and our net income obviously it's 240, right? But here we want to record the decrease in inventory, because this was a credit sale and obviously we sold 400 worth of inventory. Okay, so we're going to say changes in inventory. Okay, obviously it's positive. Okay, then here we're going to say total changes in cash, right? So obviously if we run here we get 160 there, right? So like I said, this total changes in cash will affect this one. So here we are going to say equals 140 plus 160, then we've got 300 there. Obviously our inventory is finished, we no longer have inventory because we have sold 400 there. And then our retained earnings is going to decrease by 240. So we're going to say 540 minus 240. Okay, then we get 300. So obviously our balance sheet balances, because we're going to say 800, which is fantastic. So let's just underline that, then Alt HBP, that's it, right? Then we go over to scenario 6. So let's just label that scenario 6. So scenario 6, and then let's just copy this, right? So we have copied that, then we paste there, Right, perfect. So let's just copy these figures there, right, and let's just do that. Perfect. Right, so let's see. Collected 500 in accounts receivables. Record this transaction in the cash flow statement and balance sheet. So now we have recorded this. Obviously, this must affect our cash account. This must go to our cash account. We must record that in the cash account. We must record that in the cash flow statement is cash inflow, because the customer is already paid. It is now paid. So obviously net income, but this time around we don't have net income, because we want to just record the effect that we've received this. So changes in accounts receivable, then here we've got we've collected 500. Okay, then obviously total changes in cash, right? So even if we do an auto sum there, it's 500. So our cash balance will increase by 500. So we're going to say 300 plus 500, then it's 800. Obviously we collected all our accounts receivables, it's 0 now. So our balance sheet is balancing because we still have accounts payables and retained earnings, which are equal to 800, which is fantastic. Let's underline that. Alt HBP, right? I think we are left with scenario, the last scenario. So here, paid $500 in liabilities from our Fed cash balance. Record this transaction, the cash flow statement and balance sheet. Okay. So we've got scenario 7, right? So we've got scenario 7. So scenario 7, we have to copy this as well. Okay, right? So we have to copy this. We've got to paste that, and obviously we have to paste. We have to copy and paste this. Right, like so. Right, so here what we are going to do is we're going to say net income. Obviously it's 0. Then here we are paying, since as you can see now our cash balance can pay our liabilities. We now have sufficient cash to pay our accounts payable, so we are going to use cash to pay for this. So we are going to say here changes in accounts payables. Obviously our accounts payables are decreasing because we are paying down that. Okay, so they are in negative. Okay, so here we are going to say total changes in cash, and obviously if we run a quick auto sum, and then perfect. Right, so here our cash will decrease by 500, so we're going to say equals 800 minus 500. Sorry, so it's 800 minus 500, and we get 300, and then here we put 0 because we have paid them. So now our balance sheet balances because current assets against this retained earnings, and that's it. So thank you guys for following along and for watching this tutorial. And if you've got any suggestions, if you've got any topic that you want me to cover in the area of financial modeling, income statement modeling, cash flow statement modeling, balance sheet, let me know. And please do me a favor, if you've liked this video, if you've liked this tutorial, please go on, hit that subscribe button, and also like this video and share it with your peers. Encourage them to come and subscribe to this YouTube channel. Thank you so much, and I love you all.